Good Morning Canada Pension Plan stands today as one of the central pillars of retirement income in the country, and recent developments show a system that is both under pressure and yet fundamentally stable for the long term. Independent actuarial analysis confirms that CPP is projected to remain fully sustainable for at least the next 75 years at current legislated contribution rates, covering both the original base plan and the newer enhanced portion. This means, under current assumptions about wages, investment returns, demographics, and economic growth, the contributions being paid by workers and employers are sufficient to finance promised benefits without requiring immediate rate hikes or benefit cuts. For Canadians worried about rising living costs and an aging population, that kind of long-range confirmation provides important reassurance that the plan is built to support current and future generations of retirees. The Chief Actuary's report functions as a comprehensive health check on the plan's finances over multiple decades. It examines how many contributors there will be, how many people will be drawing benefits, how long they are expected to live, and what returns can reasonably be expected from the investment fund. In the latest assessment, the calculated minimum contribution rate needed to keep the plan in balance remains below the legislated contribution rate, which gives the system a margin of safety. That cushion is central to the conclusion that CPP is on a sound footing, even as the report acknowledges uncertainty about future productivity, longevity, and economic cycles. Overall, the message from this official review is that CPP is not on the brink. Instead, it is structured to withstand foreseeable demographic and economic pressures. At the same time, the investment arm that manages CPP assets, the Canada Pension Plan Investment Board, is facing heightened scrutiny for some of its strategic choices. A particularly high-profile example is the board's decision to invest roughly $400 million into Elon Musk's artificial intelligence company, XAI. This commitment came as part of a major funding round that also included large global technology and financial players, and is tied to building massive data center infrastructure to support XAI's Grok chatbot and related services. From the board's perspective, this reflects a belief that cutting-edge AI infrastructure and applications can generate strong long-term returns, and that exposure to this rapidly growing sector is in line with its mandate to maximize risk-adjusted returns over decades. However, this same investment has sparked criticism from multiple directions. Some observers question the reputational and ethical implications of backing a company whose chatbot has been linked to deepfake and disinformation concerns, and that is closely associated with a controversial corporate leader. Others point out that such investments may amplify exposure to fossil fuel-intensive data centers and raise questions about whether the fund's climate commitments and responsible investment policies are being rigorously applied. Advocacy groups argue that decisions like the XAI stake highlight the need for stronger public accountability, clearer ethical guidelines, and more transparent reporting on how social, governance, and climate risks are weighed alongside financial return projections when CPP money is deployed. These debates about investment strategy unfold in parallel with the more day-to-day realities that matter most to retirees and near retirees: the size of monthly payments, how they keep pace with inflation, and what steps are needed to maintain eligibility for income-tested benefits. CPP benefits currently in payment receive an annual cost of living adjustment based on the Consumer Price Index, and for 2026 that adjustment is 2%. This indexing is crucial protection against inflation eroding purchasing power over time. The rules are designed so that benefits increase with inflation but are not reduced if the CPI happens to fall, giving retirees a one-way safeguard. For many households, this predictable inflation-linked benefit forms the backbone of their retirement budget. Alongside CPP itself, the broader system of seniors' benefits remains essential, especially for lower-income Canadians. Old age security provides a universal base benefit for most seniors who meet residency criteria, while the guaranteed income supplement tops up incomes for those with little other income. Eligibility for GIS is determined primarily through the annual tax return, which is why seniors are strongly encouraged to file their taxes every year, even if they owe nothing. failure to file can lead to delays, interruptions, or reductions in GIS payments simply because the government lacks up-to-date income information. Using direct deposit for CPP and OAS also helps ensure that payments arrive securely and promptly, without the risk of lost checks or postal delays. There is also important movement in the pensions that cover federal public servants, which, although separate from CPP, shape the retirement landscape for many workers who will also draw CPP. The federal government has proposed an early retirement incentive program through the Public Service Pension Plan. Under this proposal, eligible employees who meet specific criteria for age, years of pensionable service, and total public service employment would have the option to retire with an immediate pension that is not subject to the usual early retirement reduction factors. In practice, this would create a window in which some long-serving employees can leave the workforce earlier than originally planned, while still receiving a full defined benefit pension calculated on their years of service. The government has presented this initiative as a way to manage workforce reductions, largely through voluntary exits and attrition, rather than layoffs. By encouraging eligible staff to retire early, departments can reshape their workforces, open opportunities for renewal, and potentially reduce overall payroll costs. Financial projections suggest that there will be significant upfront costs associated with the program, since more people will be drawing pensions sooner than initially expected. However, these costs are expected to be offset over time by reduced pension contributions, lower salary expenses, and potential restructuring of positions. The details of implementation, including exact eligibility groups and timelines, will determine how many employees take up the offer and how large the long-term savings actually are. These public service changes intersect with the wider demographic transition Canada is undergoing. As the country moves toward becoming a super-aged society by the end of the decade, with more than 1 in 5 residents over 65, the overall balance between contributors and beneficiaries becomes an even more central concern. Fewer workers per retiree means each worker's contributions carry more weight in financing benefits. The partially funded nature of CPP, with a large pool of invested assets, helps buffer this demographic pressure, but it does not eliminate the link between a healthy labor market and a healthy pension system. Strong labor force participation, productive employment, and immigration that brings in younger workers all support the contribution side of the equation and reinforce the plan's long-term stability. For younger Canadians, there is an ongoing conversation about how CPP fits into their future retirement plans amid rising housing costs, student debt, and concerns that workplace pensions are less generous or less common than they once were. The enhanced CPP, which has raised contribution rates but also promises higher eventual benefits, is designed in part to respond to these pressures. Over time, as more years of contributions are made at the enhanced levels, replacement rates for middle earners will be higher than under the previous rules. This is intended to ensure that the public pillar of the retirement system does more of the heavy lifting, especially for those who may not have access to a strong employer pension or sufficient personal savings. Nonetheless, there is no shortage of voices insisting that the system cannot be complacent. Climate-related financial risks, rapid technological change, and the possibility of more frequent and severe economic shocks all raise questions about whether traditional assumptions used in long-term projections are still conservative enough. Critics emphasize that if climate damage, stranded assets, or abrupt policy shifts hit portfolio values harder than expected, the cushion currently seen between required and actual contribution rates could shrink more quickly than the actuarial models suggest. They call for more rigorous stress testing, scenario analysis that incorporates worst-case climate and market outcomes, and an accelerated shift toward investments aligned with a low-carbon, resilient economy. On the other hand, suddenly tightening constraints or making abrupt shifts in investment policy also carries risks, including the potential for lower returns or missed opportunities in sectors that are still evolving. Managing a fund of CPP's size requires balancing long-term return targets, risk controls, and public expectations about ethics and sustainability. This balancing act is further complicated by the fact that CPP is designed to be insulated from day-to-day political interference, with the investment board operating at arm's length under a clear mandate to maximize returns without undue risk. That structure is meant to protect the fund from short-term political pressures, but it also means that accountability relies heavily on transparency, regular reporting, and informed public and expert scrutiny rather than direct political control. For individual Canadians, what emerges from all of this is a picture of a system that is robust but not static. Benefits are being paid and indexed. The plan's long-term sustainability is strongly supported by actuarial evidence and reforms like the CPP enhancement, and the Public Service Early Retirement Initiative are reshaping how different generations will move into and through retirement. At the same time, there are real debates about how the money is invested, how new risks are incorporated into planning, and how the system can fairly balance the interests of current retirees, current workers, and those who will not retire for many decades. Staying informed about these issues, filing taxes on time to protect income-tested benefits, and understanding how CPP fits alongside personal savings and any workplace pensions are all practical steps Canadians can take to make the most of a public pension system that is both a source of stability and a subject of active public discussion. If you found this video helpful, please consider subscribing to Canada Pension Updates for more clear, accurate, and timely pension news. Share this video with someone who needs to know. Goodbye.